Right, hello everybody. This is Adrian speaking. Let's get started, shall we? This is Adrian from Trend Signal, head of trading here, and what I'm going to do today is take you through a bit about trading the 2-minute chart. So this is about day trading today. Now, if you've been to one of our screen shares before, Tuesday lunchtimes, we'll just go through various different topics, really. So certain topics that people, I think, should really need to know about. Sometimes we go through some real beginner level topics, so setting up a trading plan or trading essentials or whatever else it may be. Sometimes we're looking really deep into trading strategy, and today we're going to be focusing on day trading. So if you're interested in trading short-term charts and getting in and out over, I don't know, 10, 20 minutes, an hour, 2 or 3 hours, basically in and out within the same day, then this will be a very appropriate webinar for you. So pen and paper probably be useful to take notes. There'll be some educational stuff that we'll go through. We'll focus on getting some of the foundations right to begin with, and then we're going to look at some of the strategy side that we use here as part of the Dynamic Trader program. Okay, so it'll probably be about 45 minutes to an hour, half and half, with theory and then practice. But it should be good stuff. So why don't you let me know? I know some of you are listening to me on GoToWebinar. If you can hear me, please do let me know. And maybe if you've already a day trader, let me know as well. So if you're already day trading, just type yes. If you're not, then just type no. And then we can just get a bit of an understanding about people's experience, I suppose, before we get into the session. If you're on a smartphone or tablet, it's going to look a little bit something like this, how you can interact. So you've got the question mark at the bottom there. You can hit that and then type into there to respond. You can type anything you like, really, as long as it's nice and friendly. In terms of the downloaded platform, it might look a bit different than this. It should be fairly intuitive anyway. You may see a very small little panel on here if you're on your laptop or desktop computer. Hit the orange button, and that allows you to type into the questions button. I mean, to be honest with you, GoToWebinar has various different ways of using it depending on the type of device that you're on, so it can be all sorts of different stuff, but it should be fairly straightforward. Okay, so Rafid is day trading already. Otherwise, it's got a lot of no's coming through, so that's cool. So that's fine, at least that way. That's not a bad thing, because it means we can try and get some of the foundations right. Keith, hello to you. I know that you are Keith M, so hope you're well. Nice to see you online. So let's get started, shall we? Look, before we get into it, just a quick disclaimer. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. You should consider how you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money, and past performance is not a reliable indicator of future results. Okay. This presentation has been prepared without regard to investment objectives or financial situation. All opinions, news, research, analysis, prices, and other information herein are intended as general information only and are provided on the understanding that Trend Signal is not rendering investment, legal, or tax advice. Okay, we can breathe now. Let's get on with it, shall we? First of all, let's just think about what actually day trading is. We need to make sure we're getting some of the right foundations right. We need to be thinking about the right time frames, the right markets, the right times of day, and then the right sort of levels of discipline. So day trading, different to end of day trading or swing trading or position trading, lots of different types of trading that are out there. Day trading is very much being within, in and out of the trade within the same day. Now you can still do that with swing trading, but I guess it's really with the intention of closing before the day is out. So you're opening the trade with the initial intention of closing it before the end of that particular day. So day traders can be and usually are a lot more focused on the charts, so it's a little bit more hands-on. So end of day traders tend to be a little bit more like 20 minutes, half an hour a day, very much more second income, quite passive, quite relaxed sort of thing. Whereas day traders, it tends to be sort of an hour, 2 hours, 3 hours a day, maybe more, depending on how much time you have, but more of a specific period of time within the day where they're focused on the charts over a longer period. So usually you're probably looking at a block of a couple of hours, that sort of thing, that you can focus a little bit more on the charts, because trading opportunities can come thick and fast. So what you need to be is a little bit more focused on that attention, rather than if you're looking for something more relaxed, something more, casual, then that's rather more where end of day trading or swing trading can come into it. Okay. What's a straddle trade? That's really talking more about options. We're not going to focus too much on options and things today. Okay, we're just going to focus on good old classic outrights. So spread bets, CFDs, that sort of thing. Margin FX you could trade, futures you could trade in this way really as well. All right. So look, time frame. Time frame is important, and there is usually a race to the lowest time frame possible, because very often what happens with traders is that they enter a trade, it ends up being a loss-making trade, and they think, well, if only I got on that trade a little bit earlier, then that actual loss-making trade could have been a winner, right? So, and then they place another trade on the shorter time frame, and then the same situation repeats itself. If only I got in a little bit earlier and gone down my time frame, so start on a daily, then go to a 4-hour, go to an hour, go to a 15-minute, go to a 5-minute. You keep going down and down the time frames in that quest of getting the most perfect entry possible. Trading doesn't really work like that, and a strategy should be able to hold up across multiple different time frames. The most important thing to do is choose the time frame that best suits your day-to-day lifestyle. Okay, so the typical time frames when day trading would be something a little bit more passive, like a 1-hour chart. I'm not a great fan of that time frame, to tell you the truth, but a lot of people use it. The 15-minute charts, that can be quite effective as well, and then something a bit lower like the 2 to the 5 or the 5-minute chart. Now, those to me are really the better time frames to look at, and that's why they're in bold. Now what you'll notice is that I haven't put the 1-minute chart in there, and whilst the 1-minute chart is okay, the problem is really down to intensity. So you don't have much reaction speed, reaction time, but probably more so is the one thing you need to think about is that your dealing costs do not get lower the shorter the time frame you're looking at, and in fact, relatively speaking, your dealing costs get higher. So the shorter the time frame you go, the smaller the move that you're really looking for. So if you have a spread of 1 point or 2 point, then actually if you're going for a 100-point target, a spread of 2 points with a 100-point target is a very low proportion. It's only 2% of the overall move, i.e. your costs are a very low percentage of the overall move that you're looking for. Trading on a 15-minute chart, you might be looking for 20 to 30 points or 40 points on the move. The same 2-point spread on a 30-point move is obviously a bit of a higher percentage as well. Looking for something like 5 points on a 1-minute chart, which is realistic, your dealing costs of 2 points remain the same. You don't get a better value of a trade just because you're broker knows you're trading on a shorter time frame. So you could be looking for a 5-point move with a 2-point cost. Suddenly your costs are now 40% of the potential move. You've got to be much more accurate on the execution as well. And we're going to talk about different markets a little bit later on as well. So what we're going to be looking at is the speed in which a market moves to help us to choose it, but we want to give ourselves a good edge here. And so what you want to be doing is trading a time frame that gives you a decent range of movement across a market that gives you a decent range of movement with low costs, but also something that can slot alongside your day-to-day lifestyle. So with that in mind, here's a question for you all. How often or how much time as a day trader would you have to trade the markets on a typical day? It doesn't have to be every day or whatever. So how much time could you allocate to actual day trading? Would it be half an hour a day? Would it be an hour, 2, 3, 4 hours? Would it be all day? All day long, 24 hours because I don't sleep? What would the answer be? You can let me know, please, in that questions box. That'd be great. So Mark would be an hour to 2 max. Kipling would be an hour. Let me know, guys. I'd like as many responses as possible. That'd be really helpful. Rafid is all day. That's cool. You've got your lifestyle is very appropriate for day trading. 2 to 3 hours, says Emma. Victoria, 2 hours. Okay. Really, the amount of time that you choose to allocate to this determines the time frame that will best suit you. Anything less than an hour, really, day trading is not going to be suitable for you. You're going to get frustrated, you're going to miss most of the trades because you're not around, and it's just going to get a bit irritating. And because it's going to get irritating, you'll get frustrated and you'll end up trading in a weird and wonderful way that won't actually be very wonderful. So really, you want to be looking at minimum of an hour. A couple of hours is kind of ideal, and that can allow you to trade quite nicely off something like a 2-minute or a 5-minute chart, which is a good time frame. Let's think of it like this. So every candlestick, you have the ability to identify a new trade, basically the way it works. So if you can look at the markets once a day for like 20 minutes, then the daily chart is naturally going to be the best time frame for you, because you have one action point per day. It's a daily candlestick. You have the close of each day once per day, which means you can action that once per day. It's pretty straightforward. When you trade on a 60-minute chart, a 1-hour chart, you have an action point every hour. Okay, so if you can only look at the markets for 1 hour a day, you're going to be sitting there thinking, well, there's only one particular candlestick I could maybe get an entry on. So 1 hour time frame is going to be a nightmare for you, because you're going to miss most of the action. You think of 24 hours in a day, maybe there's 10 hours of good active movement. You're missing 90% of the real action. That gets horribly frustrating. Okay, so if you can only got a couple of hours to look at the markets, the 60-minute time frame is not good for you, because you're going to only look at one candlestick. Rubbish. Trading on a 15-minute chart will give you a bit more action. Okay, so if you're able to look at the markets for an hour, you've got 4 different candlesticks. But the problem is, if you're only looking at the market for an hour, you need that market to actually A, give you a signal early, and B, allow you to manage that trade before that 1 hour is up. That's not going to happen, or if it does, it's going to happen very unusually, and you're going to end up forcing certain moves, which again means you're not going to be sticking to the real strategy that you should probably be following according to your plan. You're going to be forcing it into a limited time. Typically, something like a 15-minute chart, you need quite a few hours to be in that trade, because the trade duration is likely to be between 1 and 3 hours. Okay, so 15-minute chart sounds great, and it's kind of like your showbiz time frame. It's the one that lots of people think you should trade, but you really need a lot of time to be able to do that. So Peter, David, Rafid, that might be suitable for you, because you're talking about trading all day or most of the day. But is it? Even then, you might well have the time, but do you have the inclination? Do you really want to sit in front of your screen for 7 or 8 hours, change to your desk? Probably not. So again, practically, it's a very difficult time frame to achieve. That's why the 2 to 5 minute charts are okay. So for a 2-minute chart perspective, if you had a 2-hour block of time, okay, within the 2-hour time block, how many 2-minute candlesticks would there be? Well, there's 30 lots of 2-minute bars in an hour, which means there's 60 candles. There's 60 potential decision points within a 2-hour period. Now, typically, a trade is going to be on for 5 minutes to half an hour. What that means is, again, off a 2-hour time block of trading, you're going to be able to get plenty of trades, and you're going to be able to see those trades to fruition. So they'll be able to open and close quite comfortably during a typical 2-hour block of time. So what you're not doing is forcing trading into 2 hours. You're trading in an appropriate way according to an amount of time that you can conveniently fit within your day-to-day. All right, so that's why, you know, you think of a 5-minute chart over 2 hours. What have you got there? You've got what? 5 minutes. What's that? So 12, is it? 12. You've got 24 candlesticks within a 2-hour period on a 5-minute chart. It's fewer decision points, longer trade durations. That's why I think that a 2-minute time frame is typically a really good one to go for, because in most people's cases it slots with their day-to-day lifestyle, and actually even those that have more time, it actually slots to what you'd actually in reality be comfortable doing. Okay, because just because you've got all day doesn't mean you want to spend all day stared at the chart. You probably want to go off and take a break and do a few other things. Okay, so everyone, does this make sense? Are we all with me? Give us a quick yes or no. Let me know that that's all. We're all on side. That'd be great. So we know our time frame. Let's think about the market. Okay, so the instrument that we want to trade. So what you're going to be looking at here is day trading for some markets. I mean, stocks can be quite, illiquid really. I mean, you can trade some of the bigger stocks, but mostly speaking, when it comes to day trading, we're going to be focusing on FX, indices, and commodities as some reasonable markets, the sort of go-to markets we might look at. That sounds kind of obvious, right? But we're going to drill down on that in a second. What you're looking for is a market that has more speed, okay? What you're looking for is a market that has a low spread. Your spread is your dealing cost, okay? What you want is a difference between the buy and the sell price, you know, the spread. Whoop, the spread there between those two prices, you want to really be as narrow as possible relative to the speed at which that market moves. So for example, if you've got a market which has got a 5-point spread and it moves maybe 100 points in a day, that's its typical daily range, then what you've got there is a 5% sort of cost, if you like. Think of it that way, like what is its spread, its dealing cost relative to the speed in which it moves. You take another market that maybe has got a 2-point spread, again versus a 100-point typical daily range, then actually that market is quite a bit cheaper to trade. Like the amount that it's likely to move is going to be pretty similar between these two markets, but the dealing cost is going to be 60% smaller. That means that actually the market has got to move less before you're in a profit. So what you want to look at is something where your dealing costs could be nice and low. But that's not the only thing. What if you had another market that had a 2-point spread? So you've got market A, you've got market B, and you've got market C. And then you've got that market that could typically moves 200 points in a day. You've got the same spread, that's nice, but also, you think about 2-point spread versus a 200-point typical move in a day, then suddenly your cost is 1%. That's pretty low too. Okay, that's even better. And then you could even have market D. Okay, market D might have a 4-point spread, but it might also have a 800-point move in a day. That's obviously a bit high, but the point I'm trying to make is that would be 0.5%. The point I'm going with here is that spread isn't most important on its own. What you need to be looking at is the spread relative to how much the market typically moves in a day. The lower that measure, the lower the spread is relative to that typical move, the cheaper that market is to trade. Okay, so how do we work that out? Well, let's have a quick look. Time zone as well is obviously going to be important depending where you live in the world, right? So, but let's have a look at it. So here's a few sort of typical go-to markets. Some indices there. I've highlighted the DAX and Dow because for reasons you'll see in just a minute. What you've also got is a couple of FX pairs, a couple of commodities, and so on. FTSE 100 typically with a CFD or spread betting broker has a spread of 1. Now the ATR, the average true range of the FTSE 100 at the moment is about 99 points, that's as of today, which basically means 1 divided by 99 is basically a 1% spread versus average true range. Okay, so it's relatively low. That's good. The DAX, typically with a lot of brokers, is a spread of around 1.5. Again, it varies depending on the broker you're with and so on. But the ATR at the moment, the average daily range or true range of the DAX is 256 points. That's how much the difference between the high or low on a typical candlestick is. That's broadly speaking what it is. It's not the exact definition, but it's close enough. So whilst the spread of the DAX is bigger than the spread on the FTSE, it moves much higher, much faster, which actually means it is cheaper to trade relatively speaking, so it actually makes the DAX a better market to day trade, all other things being equal, than the FTSE 100. Okay, and you can go down this list and see it in similar terms. So you have the Dow also even lower, largely because the spread's okay, solid enough, but the average true range is really high. Crude oil, by contrast, that's a massive range in a day. It's quite volatile at the moment, right? But actually its spread is quite high, which then makes it one of the more expensive markets to trade, relatively speaking. So it's for these reasons that we tend to focus a little bit more on the DAX and the Dow, okay? Because it tends to give us greater opportunity. Now the other thing you need to think about when choosing a market is kind of, well, think of it this way. There is a certain Let's see a couple of questions come through. Let me just cover off on these. Rafid, the broker does not charge for the spread. I mean, there is no commission. So some brokers will charge a commission, particularly on foreign exchange. Otherwise, you typically get a spread, which is more likely to be the case when trading. Depends on the broker, your type of broker you're with, to be fair, Rafid. But something like an index, you'll typically trade something with a spread, like a CFD broker. You'll have a spread of 1, 2, 3 points or whatever it may be. So that is effectively your dealing cost. There may not be a commission, but your commission is implied by the difference between the buy and the sell price. Because whether it's a spread or commission or both, the amount the market has to move in your favor before you are breaking even on the trade is a combination of the spread and where you charge commission, spread plus commission. Does that make sense? So you bundle it all together, that's your implied dealing cost. Okay, so that's something you've got to be careful of. Yes, Mike, this is recorded and it is going to be shared on Facebook and YouTube. You can have a look on there so you can catch up, no worries. Okay, so hopefully that's all right. Now, one other thing you need to think about is when you're thinking about your market choice, foreign exchange seems to be relatively cheap. Well, there's two things about this. Number one is that it's actually quite volatile on Forex at the moment. So there's quite big, typically daily ranges at the moment. Often, euro-dollar's only got a range of daily of about 60 pips. Dollar-yen, probably about 50 pips. So actually, they really are moving quite fast at the moment, which is unusual. What I would say to you is, though, is this. That in a typical day, there is a certain amount of random movement that takes place. And I say random because, take currencies for example, some people are buying currency to go abroad, some people are doing this, that and the other because they need to just get business done. Okay, so this is kind of random. It's not trend following, it's not really with much purpose, it's just random execution in a way. What happens is that I think really in any day you could probably look at a certain amount of movement that is trendless. And the more a market moves, the more the trends are in control. So what I would say to you is something like euro dollar or dollar yen, the proportion of random movement compared to trend following movement in a day, I mean over a period of time when you're swing trading doesn't really matter, but day to day, I'd say that random movement is relatively high compared to a typical move. So if you're looking for 5 to 10 points, you can end up with a few more false trades because actually it's just a little bit more random than good vigorous trend following. So I would say to you that whilst Forex seems relatively cheap, unless there's something going on that move, there's something that's really juicy, something that's creating life, like interest rates decision or monetary policy or interest rate decisions, non-farm payroll, something that's going to create life, something that's really just happened on the euro, which for the next couple of days is going to create extra speed and extra trend following. To me, currencies are actually harder to trade because what we're typically looking for is markets that have the potential to overshoot, to extend further. And again, relative to dealing costs, these two markets, you could add the Nasdaq in there, you could add the S&P 500 in there as well. Those index markets tend to be extremely good value to trade and they have good volatility relative to that. Again, guys, I've probably laboured this a little bit, but I think what we have to do, as in anything we do, whether it's trading or otherwise, it really helps if we understand why we do something. Now, I could just simply say, look, the best markets are the DAX and Dow, let's move on. But I think we have to understand why. Okay, so again, guys, does this make sense? Are you with me? Yeah? Give me a quick yes in the questions box, and then we'll crack on. And keep the questions flooding through, guys. We like a few questions there. That's good. Okay, so now we've drilled down to a time frame and why we like it. We drilled down into a type of market and why we like it. You could disagree. You can trade whatever you like. At the end of the day, I'm not your mum. But what I am here to do is try and provide a bit of guidance there as well. David, what if you did a trade for 10 UK pounds and it wins? What will you get back? I'm from the UK. So David, what you get back, so if you do a £10 per point, is that what you mean, David? Then what you make on that trade will depend on how many points you make. So if you buy the FTSE at, let's say, 6,000 and it goes to 6,010, you'll have made 10 points, multiply that by your stake per point, so that'd be 10 in your case, times by £10 per point, 10 times by 10, that'd be £100 profit. Okay. Okay. Rafid, we'll talk about direction and strategy in just a second. Okay. Good. We're all awake. So now we know market, we know time frame. What about times in which to trade? Now, it is perfectly right to say that not all the time in the day the market's best to trade. Okay, there are certain times in the day that are better to trade than others. All right, so let's think of it this way. There is a difference between the accuracy of data when you look at a sample of data, or whether you look at the full census of information, the consensus that everybody, responding. The smaller the amount of data that we are analyzing, the less accurate that analysis is likely to be. That makes sense, right? As day traders, we really should be analyzing and trading markets when their data that we are analyzing, that the charts are analyzing, that our indicators are analyzing, that our candlesticks are analyzing, are as high as possible. This is why there are certain times of the day that are just simply not as interesting to trade, and therefore likely to be choppy, indecisive, harder to find true market direction. So the time at which you trade is actually quite important, and I would encourage you, if you are going to day trade, to focus on the times of the green blocks that we're looking at. This is UK time, by the way. The time blocks here where the market is likely to have more decisive direction. And let me explain why that is. So if you're going to trade the DAX or the Dow, these are European and US stock market indices. Who the hell is trading European and US stocks at 3 o'clock in the morning? Nobody. Okay, so why on earth would you trade those instruments at 3 o'clock in the morning? We're talking about day trading, right? We're talking about it being in that opportunity for maybe half an hour. If you're going to do anything, you'd trade the Nikkei, you'd trade the the Hang Seng or something like that. What you're not going to be doing is trading the DAX or the Dow. So these are low volume times for that market. They tend to be a little bit jumpier, they tend to be a little choppier, less decisive, and much tighter ranges. So they tend to have less push behind them. It makes the movement of them, back to what I was saying earlier, a little bit more random and therefore not really all that tradable on a consistent basis. So let's think about other times. From about 7 o'clock in the morning is really when the FX markets, the bond markets really get going. That's when they start opening in the European time zone. So that's when they start to get a little bit more interesting. So really from sort of 7:30, 8 o'clock is when we start to get a little bit more life into these markets. So the higher volume times, where the markets have got a greater chance of breaking out, tend to be the best times to go for the markets when we're green here. And why is that? Well, these are surrounded by, you got in the morning, 8 o'clock in the morning, you've got sort of 1:30 to 2:30 US stock market open, and then it dies down a little bit until you get to sort of 6 p.m. onwards. So why are these points of the day from there to the right, why are these interesting, and why does it then subside? It's interesting because at 8 o'clock is when the German, the UK stock markets open, and also when some economic data in the Eurozone kicks in. See, what happens is that institutions will be making decisions based on new information. Think of it this way. The markets will carry on the same direction that they were going unless new information comes to light. That new information could be market stimulating event. It could be like economic data in Europe. It could be just the stock market opening, or it could be corporate results. It could be anything like that. That tends to happen around 8 o'clock. That creates a boost in activity because suddenly pension funds and hedge funds of this world are repositioning their portfolios based on what's happening. Okay, so they're not really doing that over here because they haven't got that information yet. What they are going to be doing is waiting, pausing, sitting on their hands, waiting for new information to come in. You look at the Forex Factory calendar, you look at whatever it is that can provide you with just a heads up to something that might be coming out. Once you get to around 8 o'clock, you suddenly get a boost of activity. So it's a little bit like this. Think of like your heart rate monitor. Doing bip, 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 bip. Suddenly the ranges get higher, overshooting, then it will slow down a little bit, less chance of a breakout in the yellow times, and then whoa, new information, US economic data, US stock market opening, lots of repositioning of portfolios, and then we hit lunchtime. You go through a period where, how long does it take a pension fund or a hedge fund to readjust its portfolio? Couple of hours based on the information that takes place, and then it starts to die down. So once that happens, you end up with this amber period, sort of late morning, early lunchtime, where the market slowed down a little bit, and then whoop, US information coming in, pre-market on stock results in the US, all that sort of stuff, non-farm payroll, 1:30 economic data, that all starts to kick in. US stock market opens at 2:30. This creates a big boost in volatility where you're likely to get bigger swings. Bigger swings create bigger opportunity. Then we hit lunchtime in the US and it all starts to faff down a little bit, and then suddenly you get into the end of the day. Okay, now why does the end of the day create more movement? Probably the biggest movement going. Well, there is a situation in the US, the way in which margin requirements are done is that during the day, like 2:30 to 9 is the US stock market, during that day, that part of the day, if you're trading futures, you're trading options, you have something called day margins and you have overnight margins. Okay, so if you hold a position overnight on the US futures markets, your overnight margin requirement is significantly higher than it is if you're holding it just during the trading hours of the stock market itself. So day margin, much lower. So if you're going to be holding that position after 9 o'clock, you're going to need a whole lot more capital on your account to do it. Most people are trading quite high margins, so what they end up doing is thinking, God, okay, I need to close my positions out before the close of the day. Therefore, I will not have to then cover that increased margin in my account because I don't have enough capital in there. And it's quite a significant jump actually. So what that basically means is you get a lot of activity in towards for the last couple of hours on the US stock market where it kind of gets really quite interesting, okay, because you get a lot of movement, a lot of, again, portfolio repositioning, closing trades out before the margin requirement starts to increase again, okay, and then it gets all super quiet again, okay. So if you think of it like a heart rate monitor, that's the way it is. We're kind of flatlining and dying, you know, overnight. This is US and European stock indices, by the way. There's a little bit more movement, of course, if you're trading Far Eastern markets. And then we get the big boosts of activity around economic data in the Eurozone, economic data in America, and the US stock market open, and then moving into the close. Okay, so think of it like that and then position your time accordingly. So if you want to trade in the morning, well, 8 to 10 will be a pretty good shout. 8 to 10, 8 to 10:30, that'd be great. The chance of breakouts happening during this period, they still happen, but are less likely to happen after around 10:30. Okay, then you move to 1:30, 2 o'clock till about half 4, and then it's 6:30. Really, 7:20 to 9 is kind of like the golden sort of hour and 40 minutes. That's where we tend to see the most movement. All right. So again, everybody, is this all making sense? Are you with me? Yeah, we good? Give us a quick yes or no in the questions box just to make sure we're all okay. Good. Okay, so what we should be doing is starting to think about a time of the day that's useful for us and probably a market that best suits that, and obviously the time frame. So with that in mind, okay, are you starting to build a picture about what might best suit you? Okay, so in terms of we've got AM, PM, and let's call it evening, EVE. Okay, so what do you think? What time of the day would probably best suit you? Guys, let me know. Just type it in, AM, PM, or EVE, EVE. That'd be great. That's what I want you to start doing. Start thinking about and building that picture of what a trading plan might look like. Okay? Okay, so Victoria is saying PM. YA. What does YA mean? Kipling. Yes, AM maybe, I don't know. Okay, either way, start building a picture about it. Okay, you're going to find DAX is probably a little bit more suited to this time of the day simply because spreads might be a little bit lower and so on. But then really Dow here and Dow here as well means really cool. AM, okay, cool, good. All right. Okay, so we're building that picture. We're getting a little bit more mirror on it, which is great. What you will find is that economic data is going to be quite important for you, so be aware of when economic data is coming out, so avoid key announcements. Now for me, just so you know, so you've got, say, economic data might be at 7 o'clock on a particular day, on a Wednesday typically for US interest rate data, Be aware of this, please, everybody. Check your economic calendars to see where the banana skins are. Do not be in a day trade at 7 p.m. You can be in the reaction at 7:02 if you want to, or 7:05, whatever, but you don't want to be covering a position on, say, the Dow or the S&Ps or the Nasdaq, whatever, coming into 7 o'clock on FOMC day. Okay, if it's a UK interest rate decision, you don't want to be in that position bang on 12 o'clock. Close it beforehand, please. Okay, because that's going to create a new piece of information, shock information, and who knows which way the market's going to go. It's going to be a lottery, right? Trade the reaction, sure. You can put on a new position that trades the movement after 12:02, but bang on 12 o'clock, it's a roll of the dice, you know. So to be in a position ahead of that is nothing more than a gamble. Close the trade out, trade on certainty. Don't bring uncertainty into your trading unnecessarily. Okay, so be aware the most important economic events are interest rate announcements and non-farm payroll. Be aware of those in particular. Okay, I guess you could say that inflation's probably pretty important at the moment for obvious reasons, but typically interest rate announcements and non-farm payroll or non-farm employment change are the most important things. Okay. You can go to somewhere like forexfactory.com, I think DailyFX, I think they've got their own calendars as well. You can have a look on there. I'm not going to go through the calendar. If you have a look, I mean, there are certain events that I've done in the past. So if you have a look on our Facebook channel or YouTube channel, you'll be able to look at how to trade news and events and things like that. So there are previous events that I've done on a Tuesday where the recordings are uploaded on there. You can have a look back through that. I'm going through some of that stuff as well. Okay. Rafid, corporate earnings come out at 7 a.m. Well, it depends on the stock market, of course. Some US stocks come out before the stock market opens. Some come out after market close. UK stocks can vary. So it does actually vary, to tell you the truth. But you should be aware of those. They are less relevant really to day traders though, to be honest, Rafid. So I don't think we're really too fussed about a UK stock reporting because they don't tend to have as much impact on the markets really. They have perhaps some, but they're not like, it's not like a non-farm payroll or something. It doesn't have the same degree of movement or impact there. Okay, so let's have a think about strategy now. So now we've got a good idea, we need to think about how we're going to look to trade that. Now, what I've got on my chart here is we're going to try and go through this relatively quickly, but there are certain things that we're going to look for to identify a trade. Okay, 3 or 4 things in order to identify an opportunity, and what we're going to be looking for this strategy is a trend following strategy. So we're looking for a market that is moving, and we're looking for really a market that is looking to break out. We're looking for 4 things on the chart. I'm going to keep this nice and straightforward today, okay? So there's a touch more to it than this that we cover off on, but what I don't want to do, this is what we cover off on coaching, and I've got literally 10 minutes to go through something with you just to give you an idea about how all this works. Okay, so what we've got is a couple of trading opportunities here on the chart. We've got number 1 and we've got number 2 here. Let's put a number against that 1 and number 2. Okay, so these are the entry points that I'm marking out here. Now what we're going to look for a trade is, well, when it comes to day trading, time is not really on your side. So with an investment, typically you can hold on to an investment as long as you like. It could be a month, could be a year, could be 20 years. And very often investors will do that and they'll see it go all the way against them, miles and miles and miles, hoping it'll come good at some point. But because it's an investment, you can kind of look to do that, and hopefully, all other things being equal, a stock should go up over time, although a lot of them don't. When you're trading, you don't really have time on your side like that. So how do you give yourself an edge? Well, it's really by following trends. The more you can accurately identify the way in which this market is going, i.e. is it broadly speaking going up or is it broadly speaking going down, the more accurate your trading will be. Because if you can trade in that direction, then if the market's more likely to go down and you're trading short, then you're more likely to be profitable than you are if you're going to be looking to buy that market at that time. Equally, if the trends are up, then you really should be focusing a little bit more on buy trades. Unless there's another reason for taking a short, you really should be looking on focusing on the overall market direction. Okay, so how do we spot that on a 2-minute chart? So each of these candlesticks represents 2 minutes of time. This movement from 1 to say the top here, that's about 20 minutes. It's actually less than that, it's about 15 minutes. Okay, so it really isn't very long at all for quite a significant move. That's about 130, 140 point move. It's big. And these are the sort of moves that can take place. So end of day traders, you might be in a trade for a couple of days on that basis, but here we could be in a trade for 10, 15, 20 minutes and take a really, effectively the more money you can make is based on how many times you risk your capital. So if you're risking 2% of your account on a trade, for example, and you only do one, and let's say it's what the reward to risk is 1 to 1. If you risk 2% on a trade, that means the amount of target you can make on that is 2%, and you only do one trade a month, it means you can only make 2% in a month. It's not a lot, is it really necessarily? Obviously, the more times, the higher the frequency of opportunities, the higher the number of times you're risking your 2% or your 1%, the more potential profit there can be. So this is why day trading can be attractive, because you're placing trades more regularly. But there's an important distinction between trading and gambling. So we're not just going to punt it hoping the market's going to go up. We're going to look for direction. Okay, so if we believe this market is going to go up, we're going to go long, and we're going to speculate on prices rising. Now, what is it that we look for? A couple of things on the chart. Number one, we want to be buying a rising market. Buying a falling market is very, 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 very dangerous to do, because if you're buying a market that's going down, it's probably going to carry on down. Okay, unless something else new comes to light, some new information comes to light, it's probably going to continue in the same direction. So to be trading against that, trying to guess the low of a market, is a surefire way of losing money longer term. Yes, we might get it right occasionally, but it can be a very stressful experience, and it usually ends up with losing. So what we're going to do is focus on a market that is rising. So the first step that we're going to look for a buy trade is to look at this band. This is like our natural trading range, and about 92-94% of price action is contained within this channel. Now, what we're looking for is a market that is rising in line with there. So I want to buy a market that's going up. Okay, so why do I want to do that? Because I'm expecting the market to then start to move. Okay, and very often, if you're trading the right times of day, that market will overshoot and expand those bands. That's what we're looking for. So what I'm looking for is the price to break from underneath the bottom half of this channel. I'm looking for it to break into the top half of this channel to show me that this is a market that is going up. So if we see here and we see here, we're buying in the top half and we're shorting in the bottom half. Okay, so I don't short up here, I short down here. So I sell lower prices, expecting prices to move lower, and I buy high and I look to sell higher. Number two, we're also going to look at these red and green lines. We're starting to build a picture of which way this market's moving. I need 2 green lines in place. So if I've got 2 green lines and we're in the top half of the channel, it's telling me that prices are rising. I know price is looking to move higher, and I know that price is in the upward direction because these lines here and here are green. When they're both red, it's telling me that on balance at this point prices alone on their own are falling. Okay, so I'm building a picture. So number one, top half of the channel, or above the halfway line effectively, and 2, I need green lines. Simple really, I'm just looking for a confluence of indicators. Number 3, to establish the overall direction of this market, I'm going to look at this blue and orange line. This line tells me the direction of this chart right now. Okay, so we've got price very short term, but also the 2-minute chart direction is also up. So when it's blue, it's rising. When it's orange, it's falling. And then finally, I need to see these arrows. This is our stop loss arrow. Effectively, it's like our initial stop loss and our protection for the trade. So if I'm going to take a buy trade, I really need my stop loss below me. If I'm going to take a short trade, like here, I really need my stop loss above me. So what I'm looking for is 4 factors, very crudely, 4 factors on the chart to determine a trade. Number 1, is price now above the halfway line? Yes, it is, because it's now closed up here. Number 2, have I got 2 green lines in place? Yes, I do. Number 3, do I have a blue line in place? Yes, I do. And number 4, is my arrow now below me pointing up? Yes, it is. So I've got 4 out of 4 factors telling me that this price is now likely to rise. Okay? And that's it. That gives us a new trading opportunity. So usually, as that arrow flips, so we go from a downward arrow to up here, price goes above, close that bar, arrow flips, that's our buying opportunity there. And you'll see the price rallies on really nicely, about 150 points or so, and then you can see the market start to break down. Arrow flips here, but we're still above this halfway line. We're above it, we're above it, we're above it. We start to break below it here. This line's still there, and we've got an upward arrow. It's not until we get a downward arrow, orange line, red lines, bottom half of the below the halfway line, that's where all those criteria are again met, and that gives us our second trade, which is a short trade from here, from point B, and there's a buy from point A. Okay, so we're looking for those indicators to line up using a 100% rules-based approach. Let me go through it one more time. There's a buy. Why? Price is above the halfway line. Okay. Number 2, lines are green. Number 3, that line is blue, the midline. And number 4, arrows now pointing is below us, pointing higher. 1, 2, 3, 4. There's a buy. And this is our dynamic trader buy trade. Again, on the short side, we're below the price is below the halfway line. Number 1, number 2, lines are red. Number 3, that line is orange. Number 4, arrow above pointing down. Again, 1, 2, 3, 4. That's a sell trade. Okay. So, guys, does this make sense? I know it can be a little bit more technical, but than a sniper disc and so on that we often have. But what I want to try and share with here, this is a rules-based approach to trading. This gives us a very repeatable entry point, and particularly once you've got a little bit of screen time, a bit of coaching, it actually makes it quite straightforward to identify a trade, because all we're looking for, crudely speaking, are 4 factors on the trade. Now, there's a couple of extra bits we can do to identify some different types of trades, but I just want to focus on the real basics today. Okay, so we okay with that? Victoria's okay, Ken Lloyd's okay. Let me know, everybody else. You still awake? Hopefully, yes. Good. Okay. So let's move on a little bit. We've got a type of continuation trade here, but let's not worry about that for now. Let's have a look at some charts and let's see what we can do on a of today's markets, and let's have a look and see where those opportunities were. So bear with me. So let's have a look. This is the DAX, okay, and this is the DAX for today, the 6th of September. So let's have a look at those particular trades. Now, can you remember what time in the day I said was good to start with on the DAX? Sort of 8 o'clock, right? 7:30, 8 o'clock. Okay. So let's have a look at what's happening around that sort of time. Did get a buy trade there, 7:32. It was a nice move actually, but again a little bit early. But let's have a look from this point onwards. Let's have a look at some trades. This is the DAX and this is the 2-minute chart. So you can see here that the price breaks down. It's against the longer term trend. So we've got red lines, we've got arrow pointing above, and we've moved back into the lower section of price, but the line is blue, which makes it against the trend. So it makes it a lower risk opportunity, so I'm not interested in it. As price then starts to rise, price then breaks back in, so price is now here, now above this line. It's blue, that's good. We've got green lines, so we've got tick blue line, tick green lines. Price is back in above this middle line as well, so that's good. And look, the arrow is now broken higher. So from the close of that bar, that arrow is violated. It was pointing down, now it's pointing up. That gives us a buy trade. And what time was that buy trade? Close of that bar at 8:02, open of the new bar. That's where we have our buy trade. Okay, this is today using the DAX chart. So really nice, clear buying opportunity. Let me zoom in a little bit because it's probably easier to do so. Okay, so let's just go through it again. Above the midline is blue. These lines are green. suggesting again that the direction of price is rising, the direction of the time frame is rising, the stop loss is now rising. So on the close of that bar, that then flips and up we go. There's our entry and a really nice move. Are we okay with that? That gives us actually a really nice healthy rally up to actually a couple of things that we can do now. Some of our traders, I'm not going to spend long on stops and targets today because actually I'll end up overrunning massively. But that was a really good move, up to its high there of what, 12900 from an entry of what, 12780. So it's over a 100-point move really. So it's a really decent opportunity. That's actually a very big move. Typically, 10 to 20 points is mostly what we're looking for on a DAX trade, but the volatility is a little bit higher, at the moment than sometimes. So there's some really decent opportunities around. But overall, 100 pips of 100 points, 120 points of opportunity on the DAX. One of the things that you'll notice is that you can go for just a simple bite-sized 10-20 point target if you want to. You can look to manage the trade in a certain way, and we'll teach you and coach you this. We've got a live trading room for our dynamic trader system, or you can trail the stop up as well. See the arrow? See how it ratchets its way up? So if you wanted to, you can move your stop loss up to here until eventually we're closed out there. Alright, so really nice trading opportunity, and that was at 2 minutes past 8 today, which, remember, okay, 8 o'clock, DAX, that's when we should be looking at the markets. Okay, prior to that is when the markets tend to be tighter. And actually notice this. You'll see this extremely clear now. Okay, look how tight that market is there. Tight ranges. Look at the narrow that band is at 6-7 o'clock. You get to 7:30 there, it then starts to widen out a little bit. You get to 8 o'clock and look how that range really widens out. And that's because there's new information coming to light, there's activity coming out, that's where the opportunity significantly increases. The opportunity down here is really low. Okay, it's not really worth trading. There's no real discernible movement. The market is likely to do a bit more, little dummy, little fake, little move, and then go back the other way. Because why would it go further? Why would it have put on a big move? Because there's no real new information to make it go up or to make it go down. So unless there's some reason for the market to move 100, 200 points, it's not going to. Okay, and the only time at which that information typically comes is over the stock market opens, economic data, and so on. Okay, that was 11,000 was in US dollars. Okay, yeah, thanks, David. Okay, so that's a buy. What we then end up with is a move back down. Okay, this is not an opportunity here because apart from any of that, again, I'm keeping this quite straightforward today, but you've got the arrows pointing down. We break back inside here, but the longer term trend is still up at that point, so it's against the trend. I'm not so interested. It's a shame because it was a decent enough move, but I'd rather focus on the higher probability setups. Look, the next opportunity that we have on the Dow, it's actually a little bit later on, but if you got that trade, you could then finish. You'd be done probably by about 20 past 8. Really nice, straightforward, and then you've probably got the rest of the day to do what you like. Alternatively, the next valid trading opportunity was here at 10.26, and it's really the same pattern repeating itself. So blue here, uptrend. Green here, direction of price is rising on both of those lines. We see then price move back into the top half of the channel, okay, and we see the stop arrow reverse. So it was down, now it flips back up again. Close of that bar, open of that bar, that's when we have a nice move higher. Okay, so we're getting into that trade just before that 10:30 time, which is kind of like when things start to typically slow down a little bit. All right, and that's where we are now on the markets at this point. Okay, so if I look at this, two really nice, clean trading opportunities in line with their time frame trends. So the blue line, green lines, top half of the channel, arrow in its direction, 1, 2, 3, 4. There's an entry point and a significant rally from there. Again, actually about 100 points move. And again, potentially, if you want to, you can take a bite-sized target, which a lot of our newer traders tend to do, 20, 30 points maybe, depending on the market you're trading. Or if you're happy to run trades, then you could use the trailing arrow to eventually get knocked out there for about, what is that, 70, 80 points or whatever it is. Okay? Making sense, everyone? You still with me? Yeah? Should we have a look at the Dow? I'm not going to be on this too much longer because I end up taking up far too much of all of your time. So let's have a quick look and see what's happening there. Again, though, it's important that we focus on the times at which we're actually going to trade. Okay, so a few more trades for the Dow, a couple more bits that we can have a look at. Let's focus on the overall direction. This line is blue, so the safest trades are in this direction. Okay, so this is a blue line, keeping it nice and straightforward. So we're looking for buy trades. I'm not interested in the short because the line remains blue. So again, we have an opportunity to buy here. Why there? Because at that point, that's when that arrow is going to flip. Okay, we don't know it's going to flip until the price breaks through that arrow. It does it on the close of that bar. Okay, this is the Dow, same time as the DAX trade. It's a similar move as one might expect. But interestingly, over that same period, we get 4 trades on the Dow versus 2 on the DAX. So that's quite interesting. But anyway, what have we got? Uptrend, green lines, price above the halfway line, so it's a rising market. We're buying a market that's expensive. Sounds mad. We're buying a market that's expensive, that's likely to go higher. Arrow flipped. That's our entry. That's the turn. Really nice move here on the Dow as well. That's about a 100-point rally. And again, you could take your bite-sized target. A lot of our traders just like to get in and out, 30, 40 points, whatever it is. Something like the Dow, 30, 40 points is a good solid objective. But those that like to run trades and try and squeeze every drop out of them, then you've got the opportunity there, with the arrow to take a little bit more. The market then starts to break back down, but of course that longer term trend is up, so unfortunately not able to get on that move, but so be it. We're not going to get on every single trading opportunity, but what we do have is a few more trades that we can get our teeth into. Number one, 954, market breaks back up, trend up, green lines, arrow up, top half of the section. What did the market do? Well, it rallies really nicely, a good 20-point move, which is pretty good pre-market as well. So, that's okay, decent enough setup. We then move into a sell trade. So again, looking at the way in which this market's going, what's it doing? It's breaking back down. It's now in the lower half. Orange line, red lines, arrows pointing down. There's a sell trade. What did the market do? Fell 30, 40 points. So again, really nice move. Bite size. If you ran into the trading stop, you've got a break-even trade. But again, for me, I don't necessarily always like going for the big, massive winners. I tend to prefer, a 30, 40 pointer and then moving on to the next trade. Okay, I tend to like to lock those gains in. And that's what you're going to look to do, because as a day trader, it's all about, if you're going to be spending 2 hours at the charts, ideally you want to walk away from those 2 hours with something. Okay, so you've got to want to get that return on your time. So typically what you're going to do is look to manage the day in a particular way. So if you're sort of 20 points, 30 points up on the trade, you don't really want to turn that into a loss-making opportunity. You want to come away with something that pays you for that time. And again, that's all down to the mindset of a day trader versus a swing trader. It is a little bit different. But again, that's something that we can help you as well. Okay. And again, we have here, then finally 1036, we had the next trading opportunity, again, as we start to then move back up again in line with those longer term trends. So decent moves taking place on the Dow and decent profit potential. Okay, so sometimes you could risk 1 or 2% on the trade, whatever it may be, but ultimately we are looking to exploit that price movement that takes place during the day. The more potential, the more times, the higher the number of opportunities you have in a day, in a week, in a month, the more potential there is that you could make. More potential you could lose as well, of course, if you've got the wrong strategy, or wrong implementation of the strategy. But the point about it is that get this right, 10, 20, 30, 100 points, whatever it may be, these moves happen every single day. This was not charts that I was looking at from a year ago. This is on a specific strategy that we teach our members to help them to identify trading opportunities. And what, we support our members using our live room, and I'm not going to go through too much about this really, but part of the thing that we do with Dynamic Trader, which is the name of the system, the package, which is a combination of course material, one-to-one coaching, a live trading room, and software. So software that you have on your device with those indicators and so on, is to teach traders how to do it properly. So this chart that I showed you earlier was actually a trade that we called in our live trading room. So our members who are following this within our live room, these are the sort of the results that they were getting. So they were just relaying how they'd done on that particular day. So I think Stuart was running that session, whoever it was, it doesn't matter. One of our coaches identified the trade as per earlier and a really fantastic buy. And those that using the system in our live room, they were making money. So some people, I don't know quite how, have managed to lose money on that trade. It's a bit mad, but it happens. But 97% of traders who are following those trades making money. Some, of course, didn't trade, just building their confidence. They're new to it and so on, and that's absolutely fine. But you can see that real people identifying real trades as well. Quick question. So you could win £1,000 if you win, say, 10 wins a day. It looks like you can win whatever you like. It depends what trade size you do, David, to be honest with you. But are there many opportunities in a day? Yes, there are. So does that give you the potential to make significant capital growth? Absolutely. If you're doing it the right way. That's the thing about day trading. We're not just day trading willy-nilly. We're doing it in a way that's going to maximize our profit potential. Okay. So I'm going to call it an end there, everybody. What I would say to you is this, that guys, if you're interested in what I've talked about today with this dynamic trader system, and you'd like to know more about day trading using this system and the course that we provide, just do me a favor, just type your phone number into the questions box, or just get in touch with us with these details on screen. But type your phone number in and I can ask one of the team, one of the traders here, to give you a call and we can guide you through that process. Otherwise, hopefully that's been a useful session. If you're watching us on social media, YouTube, Facebook, etc., then give us a like, give us a subscribe, and hopefully you can tune into future sessions that we do on various other topics that we cover here. All right. But as I said, if you want to learn a little bit more about this and want to find out a bit more about this system, just pop your details into the questions box and then we'll give you a call and go through from there. Or alternatively, there's your phone number, there's the email address that you can contact us on, and we'll happily guide you through how it all works. All the best, everybody. Have a wonderful day's trading, and I hope today has given you some good, useful insights into how to day trade effectively. All the best. Bye-bye for now.